The concept of a variable dividend is something that's been around for a little bit of time, but there's been a hesitation for companies to adopt the concept. And obviously, dividends are a great thing. They're a great way for companies to return cash to shareholders. They're great for yield-seeking investors. However, when fixed dividend payments get too high at a good part in the economic cycle, that fixed dividend payment can overwhelm a company's balance sheet and cash flow in a weaker part of the economic cycle. And as you referenced, that's what we're seeing a lot of today. So the concept here is to tie a dividend to a percentage of the company's economic cycle. Shareholders get a very good dividend that doesn't overwhelm a company's balance sheet. But as the economic or industry cycle declines, as we're seeing today, the dividend comes down naturally as a company's free cash flow comes down. And in that way, a company can still return some cash to shareholders without having to go out and raise capital to pay a fixed dividend payment that was set when the cash flow was at a better time in the cycle. And so the whole concept here is that we can continue to return a lot of cash to shareholders at the top of the cycle and be efficient with a company's capital structure. But at the same time, when the economic cycle declines, the dividend naturally declines without hurting a company's balance sheet and forcing a company to go out and raise very expensive debt or equity at a more difficult part of the cycle.
Jim, there's a lot of really fascinating stuff in the note you put out and in that answer. I guess buybacks should be included in the talking point as well and factor in total shareholder capital return. I mean, does this not also suggest, Jim, that just borrowing at all for capital returns is the silly thing, perhaps, that doesn't really stack up based on the analysis you've made?
It's a very good question. And obviously, the situation is going to differ a little bit for every company at every different point in the cycle. But one of the things you do see in better parts of the cycle is companies are cognizant that they don't want to raise the dividend too much at a good part of the cycle for fear of what's now happening today. So you see companies buy back stock at the top of the cycle sometimes. And obviously, the historical data says that companies typically wind up buying back more stock at a good part in the economic cycle. And then they unfortunately wind up buying less stock back at the bottom of the cycle. And one of the things we argue for in the note is that this will allow for companies to return capital to shareholders in a much, much more efficient manner. And so, you know, oh, sorry, go ahead.
No, I'm just, isn't the whole thing with dividends, though, people like to buy stocks with dividends because they have a predictable, steady stream of income? Retirees, for instance, who depend on that kind of income coming in. I mean, doesn't this make it a little more uncertain?
Well, that's the idea, right? And that's why companies have been somewhat reluctant to adopt a strategy like this. However, as you highlighted, there's so many companies that are now cutting their dividend. And most importantly, the stocks of the companies that pay a big dividend today are declining significantly. As we demonstrate in the note, the stocks of companies that are paying a big dividend have underperformed the market by more than 15% during this episode. And so investors are already selling those stocks of the companies that pay the big dividend, assuming that they may have to cut the dividend. And so if investors are going to sell the stocks of big dividend payers in a tough economic environment anyway for fear that they're going to have to cut the dividend, and yet those companies are still going to have to pay that fixed dividend, potentially stressing their balance sheet in order to do it, we feel it's a much more efficient way to return capital to have that dividend tied to cash flow as opposed to a fixed dividend payment that you either have to cut, which obviously comes with a big stigma associated with it, or you have to go out and raise capital in order to cover that dividend.